Good evening, and thank you for joining us for tonight's webinar, Digital Assets: Birth of a Universe. This will be our first in an upcoming series about cryptocurrencies, so I hope you all enjoy it and let us know your thoughts afterwards. This evening, I have the pleasure of introducing Cooper Union graduate and Vice Chair of our board, Eric Hirschhorn, Mechanical Engineering, Class of '89. Eric is an authority on how technology drives transformation in financial markets, and he is currently the Chief Data Officer at BNY Mellon, as well as the co-chair of Cooper Union on Wall Street. Now I'll pass it over to him to get us started.
Crystal, thanks very much, and thank you all for attending. I think I used to be an expert in how technology transforms Wall Street, but I think I'm going to introduce a panel today that probably could run circles around me many times over. So tonight we're digital assets, the evolution, the technology involved, really what this group of people thinks, and what I think is the path and the way of the future in terms of old finance and new finance. Without further ado, let me introduce our panelists. Ian D'Souza is a professor of finance and blockchain at NYU Stern. Ian, would you introduce yourself and tell us a little bit about yourself?
Sure. Thanks, Eric, and thanks for having me. As you know, I'm a professor at NYU in blockchain and behavioral finance. And prior to that, I was the CIO of a multi-billion-dollar hedge fund and moved on from that to academia. In the last 4 years, I actually sit on the protocol boards of 3 different DeFi protocols right now, which is super interesting. And we'll get into that a bit later, Eric.
Great. Thank you. Next, I'd like to introduce somebody I've known for a number of years, Rick Schoenberg. He is the head of trading product at Coinbase. Rick, tell us a little bit about yourself.
Hey, Eric, thank you very much. I've bounced around in TradFi, as it's now officially called, for a handful of decades, a few of those bumping into Eric and others. Again, I've spent my time mostly in the foreign exchange side of big banks, doing electronic trading work, doing what I thought was transformational, but in hindsight, especially for my current perch, it looks more evolutionary than revolutionary. So been involved in the microstructure of traditional markets and electronic trading, and now at Coinbase, helping institutions as they access digital markets. So a very exciting time and looking forward to the conversation. Thank you, Eric.
Great, thanks, Rick. And next, I'd like to introduce a colleague of mine from Bank of New York Mellon, David Schwed, who is head of digital assets technology at Bank of New York Mellon. David?
All right. Yep, thanks, Eric. So I recently joined BNY Mellon, so my charge is to head up the digital asset technology initiatives within the bank, the foundational technologies. Prior to that, I was the chief security officer for Galaxy Digital. I also spent a few years in academia as the director and professor of cybersecurity master's program at Yeshiva University.
Great, thank you, David. So listen, we're gonna kind of start. Let's put some ground rules for tonight. We've got a bunch of questions we've come up with that we're going to ask our panelists. And as we're doing that, there's about 150 people online. We'd love to get your questions coming in as well, and we'll steer the conversation relative to the input we get. I've been talking to these guys and educating myself, as I hope you all do from these panelists on digital assets. I think it's fascinating whether you're reading the paper on wealth creation and where Bitcoin is going, or on distributed ledger technology or NFTs. I think it's fascinating, and I'm hoping to learn more tonight. I think we'll start with Ian. In the conversation that you and I had, I think we all had a couple of weeks ago, when we were thinking about this forum, you were the one that came up with Birth of a Universe. Maybe you could, give us kind of a little bit of a guide to the digital asset space, and also why you think about it as Birth of a Universe.
Sure, thanks, Eric. And other than patenting the actual language, I think the way I think through it is twofold. As I tell a lot of students and a lot of what I think Rick called TradeFi boardroom members, there are 2 ways to think about it. Way one is that we all traditionally understand stocks, bonds, gold. So that's an instrument in a class. So that's one way to look at it. The other way to look at it is we've always believed in trust and technology based on a jurisdiction. And for the first time in our life, we can see consensus and code actually not required. And so we can think about a brand new instrument called a token or a coin that can fluidly move across borders and across standard frictions that are not so easy to do with stocks, bonds, or weighty objects like gold. And so, you know, when I think about a universe, I thought about the regional universe that we've always lived for about 500 plus years, to what I now call the virtual universe, which is the ability to move things without a natural border. And I think when you do it that way, you are now talking about trust, not in regulation, not in code, but trust based on technology, governance, and the community that supports that. And I think it's a very different way to think. It's only 10 years old. It's worth $3 trillion today, the token and coin market. The gold market is worth, after, you know, multiple thousands of years, 10 trillion. And the stock and bond market, which sort of officially got created around the 1600s, that's worth about 400 trillion. So when you think about it, even though everyone's excited that it's a 10x from 1 year ago, it's minute in the grand scheme of instruments and value, because for the first time, we can actually think about it without a border, without Silicon Valley, without, you know, Europe. It's now global in the way you think about the concept. And that's why I called it the universe.
That's fascinating. I have my own question, but I'll keep it to later. How we get from, you know, gold standard to paper standard to, you know, kind of ethereal value. Maybe for that, David, maybe you can kind of help us understand. You know, you work at one of the largest custodians in the world, who are custodying now digital assets. You know, based on what Ian says, you know, how do your customers think, or maybe not your customers, how do the world at large think about the intrinsic value of math?
I think it's, you know, for this answer, I think you have to split out, like say Bitcoin and Ethereum. And the first thing, it's important to realize that Bitcoin is not the first attempt at virtual currency. I mean, there have been attempts since the 80s to try to virtualize currency. And I think Bitcoin was a product of right place, right time, you know, based on the ubiquity of technology, everybody having smartphones, and to be able to, you know, load up an application in order to, you know, send that transaction. But if you look at Bitcoin at its core, Bitcoin is really just a store of value, right? It's digital gold. It doesn't provide any function per se. And I think from the intrinsic value perspective, I think it's about the market adoption is really what drives the value. And if you look at like the proof of work, there are incentives in order for this entire ecosystem to sustain itself, right? So there's block rewards for miners in order to provide the computing power in order to, you know, continue on producing the chain, and there's also transaction fees. So there's this nice, you know, self-sustaining model in the Bitcoin world. And I think Ethereum is a little bit different. Ethereum actually has a use case, right? So Ethereum, you have the ability to run code. So you can look at Ethereum as this worldwide decentralized computer where you can run code. And there's so many different use cases. I mean, you're talking about use cases to disrupt the legal industry, you know, talking about wills and trusts, and you can, you know, avoid probate by building in code to say that upon a certain event, this is where I want my asset to go. Or, you know, there's something called oracles where you can actually, you know, pull in extraneous data points from the outside world and say, you know, when this event happens, I want this to happen to my asset. So you can kind of start, you know, building in these types of technologies. And again, the decentralized nature of it provides that security of, you know, there's not this centralized authority that's going to be able to shut down my code, if you will. The other side of it is you know, again, going back to Ethereum, it's that same self-sustaining model as well. In order for your contracts to run, you have to pay gas in the form of Ethereum. So that in and of itself, there is actually intrinsic value in Ethereum because you have to pay in order for your smart contracts to be able to execute on this, you know, worldwide decentralized computer.
Thank you. That's really helpful. And, you know, while you were talking, we've got some questions coming in. And so maybe Rick, Fred is a graduate of Cooper Union from 1960. He's on the call, and he is not so much a believer in digital assets. Maybe you could kind of help us kind of bridge the gap between old fi and new fi, between fiat currencies, maybe explain what fiat currencies are, and digital currencies, and how does an investor who's used to picking up a dollar or knowing what a stock is or knowing what a bond is, what's the bridge there? How do people get comfortable with it? What's the transfer mechanism, if you will?
Sure. So it's an excellent question and not one that's sort of easily answered. If you're sort of 90% skeptical, now if I can get you to sort of 60% skeptical, I'll call that a massive victory. If you think about what your money is today, you have bonds in an account at Fidelity, and you have, say, dollars in your account at JP Morgan. But what are those? How are those materialized today, Fred? If you think about them, your bonds at Fidelity are on a database. You can call that a ledger, a non-decentralized or a centralized ledger at a securities clearing corporation. Your dollars at JP Morgan are on a database. If the world went sort of Fight Club style and the JP Morgan database melted down, you'd have a tough time tracing back to your US dollars because they're just digitized at a single bank. The concept of some of these digital currencies and digital assets is, well, what if we take something and instead of digitizing it at a single bank in a single bank's database, we have the shared database that we all support and all pay for, where we record things there. Thus, if JP Morgan decides we don't like you and we want to close your account, there isn't someone that can do that, or if there's a government that wants to do that. So the concept of what is an asset today and these crypto-y things sound very complicated. It seems like it's like a Grand Canyon in between them, but there really isn't. So I think that's sort of the first sort of dichotomy to sort of cross, which is that there really isn't, everything is digitized today. It's just whether it's something we're used to like fiat or something that's not. So going to the difference between what is a fiat asset versus something else, a dollar issued by our government or by a currency issued by any government is considered fiat. It's something they say has value. They control the issuance of. And if we go back in our own history, we had various states issuing currencies. We had various banks within each state issuing various currencies. New Jersey defaulted, I think, in the 1780s, and all the currency went to zero. So there's a history of fiat currencies and valuations, devaluations, inflation, and that's not a new trend that's sort of been going on forever. So I know we'll sort of get into this in sort of other conversations as well, but just as we think of what are these stores of value and what are these assets, if people agree that gold is worth something, then if enough people think it and you're willing to sort of transact in it, then consensus is correct. It has value. If people think a Rothko painting is worth $100 million, then the person that bought it for 10 million is a genius. I think my kids could have drawn it. I'm not a Rothko fan, so I'm a cynic. But again, so what is value? What is fiat? What is not? In a world where everything is digitized, it suddenly makes, as Ian was saying, the world very fluid and very low friction. And institutions that have fed off of friction, not to pick on banks here, but if we call them banks by chance, this is we were talking NuFi versus TradFi in a bit, but this is sort of the challenge that is before them.
Rick, thanks very much. If we kind of continue on that theme at NuFi versus old fi, Ian, I think I remember you telling me kind of some views about the intrinsic value of digital assets versus what's happened in emerging markets over the last number of years. Maybe you could kind of help take us through a little bit of a history of volatility in the emerging markets and how you see, kind of digital assets equating or not equating to that.
Yeah, and I just want to step back and try and give a different perspective to Fred's question that you just asked a few minutes ago, Eric. Fred, let me be clear. I'm supposedly a professor in blockchain, but for the first 4 years from 2010 to 2014, I thought it was crap. I was like, what is this garbage? Okay. I didn't buy it. I didn't trade it. I just thought it was a joke. But I started studying it for one major reason. It was not consensus. It was not frictionless or borderless value. I started studying it because it had within the code a structure around coin issuance or scarcity, we call it. Now, the first thing I thought about was, oh, they can just change the code and make it whatever they wanted to do. And then I said to myself, well, why can't a government do that? And then I realized something that shocked me. The Bitcoin paper was issued just after Lehman Brothers went bankrupt in 2008. And here was the part that I didn't connect, which was stupid of me, which was it was issued also 4 months before something called quantitative easing 1 or QE1. Do you know what that is? Basically the printing of money. In other words, there was no code restriction to keep on printing money. We call that fiat or US dollars. And I started to realize if you start trusting code instead of people, maybe there's a version of value there. What that version of value, that's unclear. It's dependent on whether the community believes in that value. But then I thought, oh, well, is this happening in other places? And in the last 3 years, 11 emerging countries have devalued their fiat currency by more than 20%. Obviously, we know about Zimbabwe. We talk about Argentina. We're seeing some effects in Brazil. But look at the Turkey lira right now. So one of the things I think Fred and everyone on this call needs to understand is the reason there's such receptivity is not just greed, is not just a standard behavioral feedback loop. Sure, they're a very large part of it. Everyone's jealous. Everyone wants to make sure they're not left behind. I get it. But there's another part, which is, as I said right at the beginning, trust in code as opposed to human beings who can change their mind every 4 years or whatever when an election comes up, is very important to generations under 35. And so I'm obviously over 35, so I come from an old school way of thinking, but it's just a mentality around scarcity and concepts around that that are very important to think about. And we've seen it with 11 emerging market countries in just the last 2 years. So there's a lot of lessons here, as Rick and David have mentioned, around valuation. Let's put it this way. The way I teach my class, it's a guess. We don't have a model, but the only models we use for stocks and bonds are based on predicting cash flows, which, by the way, 80% of the time or more are wrong. So guess what? We believe in a model where its error rate is 80% or higher. That's kind of weird too. So I leave that with you, and I'll pass it back to you, Eric, but I wanted to put that context because we have this undying belief that we can model stocks, bonds, and hybrids, and even gold. But is that not just a version of us being used to something rather than testing a new way to think?
I love that. So Ian, you're basically saying that we should trust that there's only a finite number of solutions to a math problem like Bitcoin, but people can print an infinite number of paper, infinite amount of paper money. And so we may.
Yes, but we need to just be careful here because I think David mentioned something. There are over 12,000 crypto tokens currently in the world, 12,000. There were less than 500 in 2016, so the growth has been massive. Of those 12,000, very few have within it something called a max cap or a max supply. In other words, they're just like human beings can print whatever they want through a governance chain. So it's important not to say, oh, Bitcoin is the standard for all coins, but Bitcoin has within it a governance protocol that would require consensus to change it. And that will probably never happen because of its scarcity value. But what I'm saying is trusting the code versus trusting human beings is a very important driver to a version of value that, you know, the young generation and the old generation definitely have a divide in.
So that's fascinating, and I didn't realize that the whole scarcity and max cap thing. I think that's, you know, I hope you write a book because I think you'll have at least 184 copies sold after this conversation. So I'm going to switch up the order a little bit because a bunch of conversations came in, and we all, obviously are in industry, and there are certain things that we are more comfortable or less comfortable with. So I may take some of the questions and direct them relative to what we all do for a living. I'm not allowed to give investment advice, so I'm not going to ask myself a question about that. Rick, Coinbase was recently in the news. Tell us a little bit about, are crypto assets or digital assets cyber secure? What happens when, we've heard about them assets being hacked? I don't expect you to talk about your firm specifically. I don't want to touch any third rails, but I think there's a lot of people who kind of know we're playing with a digital something, which means it could be tapped into and stolen from someplace. How do we get our heads around that? I've got a document safe and my passport's in it, but if my passport were in a blockchain someplace and somebody stole it, how do people in the industry think about cybersecurity when it comes to digital assets?
Terrific. It's a good question. Obviously, I won't speak to specifics either per se. As the world we all live in, and especially if you're younger than we are here on the panel, the bulk of your existence is digital. Everything you have is in email and chats, personal documents, personal information. Securing and safeguarding that, use a password manager, use good passwords, update the operating systems on all your devices. Just take care of all of those things, because forget, your email's hacked, you have identity issues. And that exists, and these are new things. And as the world goes into digital assets, if someone still gets access to your banking account and banking information, they can impersonate you, they can make withdrawals from your bank, and they can lose money. That's capable of happening. If the same thing happens in the digital space, given the speed and fluidity of movement of digital assets, the low friction that Ian and I discussed as benefits, the downside of that, obviously, is that the speed and fluidity can be an outflow. So we strongly encourage people to move things to what is called cold storage. We strongly encourage people to use multi-factor. Do not rely just on SMS as your second factor authentication. If anything I say today is something to be remembered, use a strong two-factor. SMS can be hacked by a SIM swap. And that is how people's, we call them ATOs, account takeovers. That's the most likely vector. They guess your passwords because they guess all your passwords, and then they do a SIM swap and you lose your money. Just digital assets do great things, and there are lots of reasons we've discussed why this is innovative and helpful to people. Everything that is good comes with a potential cost, and this is your people are right to ask this question. And they should. It's a hard question to answer, but people need to take it upon themselves to protect their assets and protect their digital identities as well.
Great, thank you. I'm sure there's a lot more to say on that topic. David, a lot of our audience are friends of Cooper Union. I'm sure there's a lot of alumni and graduates. From an engineering perspective, like, what does it take to be involved in digital asset technology, to be in the industry from that perspective? How does one get a job in it? What are the skills required? And also while you're there, maybe you could talk a little bit to who controls the code around, if you're getting involved in digital assets and you're thinking about, you mentioned that there's a max cap on Bitcoin. How do we know who controls that code? So maybe you can kind of hit those two topics for us.
So the first answer, who controls the code, is everyone, right? So the code is open source. You can look at it, and in fact, you can just Google $21 million cap, and you can see exactly where in the code it says that there's again, it doesn't actually say 21 million. It just talks about there's something called like halving, where you can actually see and through math figure out that there's a 21 million coin issuance cap on Bitcoin. And to Ian's point before, it takes a consensus. It takes everybody who's running their Bitcoin nodes that are running a certain level or release of code. So if somebody wanted to change the 21 million cap, they're welcome to. But what they're going to end up doing is forking Bitcoin into their own version of Bitcoin. It's not going to be adopted by the community, and then they're going to have this rogue chain that's going on, and it's not going to be taking over Bitcoin. So anybody can take the Bitcoin code, fork it, and come up with their own chain, but it's not going to be Bitcoin. It's going to be a new version of Bitcoin, and it may take off and it may not. Just like we see Bitcoin Cash and Bitcoin Gold, there's a ton of forks off of Bitcoin, and that's the beauty of it. Anybody can take the code, maybe come up with something better and release it, and then if the market adopts it, that becomes what the hot crypto is. But to answer your question, what does it take to get into it? Number one is a really deep understanding of this is a disruption, right? It's a decentralized ledger technology. There's no centralized authority. It's really learning and understanding and loving what you're doing and believing in it. I think that's probably at its core. It's not so much, this isn't the type of thing where you wake up and say, I want to get into digital assets or cryptocurrency and let me just take a course or two and just get into it. You really have to understand it at its core. So I'd recommend there's great courses. edX is free. There's a number of institutions that provide free content into edX, EDX. There's a number of certifications. Bitcoin Council, C4 Consortium is a number one I highly recommend. So I would tell everybody there's a ton of free material. There's a ton of podcasts, and just really immerse yourself in the technology. And what's great about it is, since it's open source, depending on which faction you want to get into, if you want to get into the technology sector, just download the clients and stand up your own node and just watch it and see, buy, a few Satoshis and, make some trades to get an understanding of how the system works. Rick was talking about cold storage and there's hot storage and there's self-custody and there's paper wallets, understanding all the technology. And there's a lot of self-learning that you can do. The great thing right now is there's such an there's such just a lack in market of talent that if you really put the work into it and you really, go to these events, listen to the podcast, immerse yourself in the ecosystem, you'll be able to find a job relatively quickly. It's the type of thing where, I'll, from my own, and I'm sure Rich is seeing it too, I can't find people.
It's I'm just, you think about that. I think it's a great job market, and
Yeah.
You can't find people in one of the hottest. I'm not surprised, but it's kind of a call to arms to anybody who may be interested, who has the acumen and the curiosity. Hey, Ian, Jakey has a question. Jakey's a sophomore at Cooper. And he was asking really about meme coins, such as Dogecoin and Shiba Inu. I didn't know about Shiba Inu, I knew about Dogecoin. Putting aside Ethereum and Bitcoin, how does one distinguish coins, and do these things have intrinsic value, right? You can look at the meteoric rise and you can read the stories, and you mentioned max caps and other things that pedestrians may not know. Like, how do you think about the other, the 11,998 coins out there that are not the ones you mentioned?
Yeah, so Jake, great question. Most of these coins are proverbially called shit. They're literally called shit coins by most people in the industry. David was saying, get to know the language. Well, one of the words that is literally spoken by all of us who have been in the industry for 5 to 8 years, we call it a shit coin. But when you think about the actual wording and, a meme coin, a Dogecoin, a dog coin, Shibu, another coin that's, doing really well in the last week, because, people hope it'll get to 1 cent equivalent in fiat, which will be 1,000 bagger 10,000 bagger, in the space of a few months. What drives that? Well, guess what? We've seen it before. We saw it in 1999 with stocks, pets.com, went up 1,000% in a week. We saw it recently with GameStop. We saw it recently with AMC. And one thing you need to understand with the concept of memes and things like that, what is the value of a meme? Well, it's the value to the community that believes in the meme. It's not a free cash flow. It's not a discount rate. It's not a tangible asset backing statement. It's 10 other people or hundreds and hundreds of thousands of other people all around the world hope that the ecosystem will create enough value that it will self-generate into something higher than it is. And when I think about a lot of these concepts, and if, Jake, you're not the only one. Every student asks me about this shit stuff. What's going to go up? What's going to go up? What's going to go? Basically greed, jealousy that their friend got in, they didn't. But we only use the word intrinsic value, I've found, behaviorally. Everyone asks me about intrinsic value if they're not in the coin. If they're in the coin, you know what? Magically, it's going to go up and they don't even think about intrinsic value. So I find it a really interesting sort of, are you jealous? Are you not in the meme construct? I can tell you, I don't know how to value any of the meme stocks, any of the meme instruments that exist, whether stocks or coins, but the community decides something. With the Rothko, I think Rick mentioned earlier, a Rothko is worth, tens and tens of millions of dollars. Well, I got to tell you, the first time I saw it and someone told me how much it was worth, I was in London, I literally burst out laughing. Like this is insane. I can take a stroke and I'll do it. But you know what? My wife looked at me and almost decked me because she says, you don't understand value. I'm like, you know what? You're right. I don't understand the value of what I consider 2 strokes of a paint stroke, right? So I think, Jake, as you look at it and you try and create a rational boundary for memes, please understand that rational boundary is the boundary as set by the community that believes in the meme. I will set the rational boundary at 0. I don't get it. It has no cap. It's designed to basically say if it can go from 0.0004 fiat equivalent to 0.01, that's 1,000 bagger, yay. But I couldn't tell you why one or the other value is right. And I think it's important to understand, Jake, that when you and hundreds of undergraduates ask me this question, I always answer it the same way. How do you value a meme to yourself? Are you willing to risk capital on a meme? I know I'm not, but guess what? I'm old. So it's a different profile of risk return that I'm looking at. I'll hand it back to you, Eric.
Thanks, Ian. So I'm just, I'm replaying what you said in my. I got to write it down because tell my kids. So hey, Rick, a couple of questions came in. I hope you guys don't mind me threading questions in through some of the topics we had talked about. So maybe you could handle 3 for us at the same time. 2 are very straightforward. Explain scarcity for a non-economics major. Explain what a wallet is, because I think there are some less initiated out there. But the real question, those are just the starter questions. The real questions are, explain the NFT market, if you will. I think there are a lot of people, including myself, who are scratching their heads as to, I realize we don't want to touch on anything that may be an unfriendly question for your industry, but maybe you could just explain kind of the pedestrian's view of the NFT market. So you got 3.
Oh, 3. So if you would have asked me about jobs, I would have said coinbase.com/careers. But since that wasn't one of the questions, I won't give that answer. Coinbase.com/careers. But 2 of the things you asked about link in together. So scarcity and NFT. So I'll sort of tackle those 2 together, and then I'll get to wallets, which is perhaps the more substantive in certain ways. Ian focused on scarcity. A coin like Shibu has no scarcity value. It can print an unlimited amount, and thousands upon thousands get issued every day. So it's highly inflationary. Whereas coins like Ether, some of the gas fees that get paid get destroyed as of recently. So it's an ever diminishing supply. So there are fewer and fewer of them. So things in the world that have scarcity, whether you think that's gold, there's a finite amount of cosmic dust that is coalesced in our planet as gold, or original Babe Ruth cards. People assign value to them, even though it's just a piece of cardboard with ink on it. Because there are only 3 of them that are known, they suddenly have magical value because whoever wants them, they have to bid up the value because there's so few out there that people can engage in. So scarcity of anything sort of underpins its value. it's just the nature of life. If you want a certain experience, if it's not unique, it's not worth that much to me. But certain things that have that sort of elite or sort of exotic value are scarcer. And like truffles. If truffle is just a mushroom, no one would pay a couple $100 an ounce for a white mushroom. But it's scarce, it's a white truffle, and we like them, so people will spend absorbent amounts on them. NFTs are sort of scarcity applied to digital art. And again, this isn't for everyone. I do own a few NFTs, more to dabble and educate myself, as David was saying very aptly. Educate yourself. You want to know about NFTs? Go to magiceden.io. It's a Solana-based NFT venue. And you can go there and very inexpensively using Solana, which is a faster, cheaper network than others. Learn some things, buy some NFTs, not spend too much money, and get an education, which is invaluable. So they're digital artworks that are created that have different attributes and different scarcity factors. And what's interesting is that the JPEG of the digital artwork that sold for millions of dollars, we can all download the original full resolution JPEG. We just don't have the password to it. We just don't have the authentication proof of authenticity. But other than that, anyone can download that digital art and display it on their wall. It's no different than having a Rothko and someone making a lithograph of it and hanging on your wall. So what gives it value is the bragging rights to say, no, I am the owner of this, maybe on loan to the museum and maybe on loan to the entire world, but I am the owner. Some people think that's worth nothing. Some people think that's worth a lot. And that's where scarcity comes in, bragging rights come in, and the perception of value. So that's sort of a scarcity in NFT sort of as bundled as one long answer, and sorry for the length. A wallet is interesting, and it goes back to something that we touched on earlier with account takeovers. A wallet is the key to the vault that holds your digital assets. So a lot about, we don't have time and I'm probably not the best person for this, but a lot of what underpins digital assets is cryptography and having passwords. And the idea of storing your password somewhere safe and somewhere where someone can't get to it. If someone gets the key to your safety deposit box, they can go into the bank and take what's in there. Interesting about a public ledger is that that bank is open to the entire world and anyone can go in and try and guess your password. But mathematically, it'll take them forever. So it's secure. If you lose that password, well, or someone gets their hands on it, if you just put it in your email and your email gets hacked, they have your password, they can access your wallets and transfer any digital assets elsewhere and re-encrypt them and move them. So it's the key to the encryption that governs your assets. Now, wallets they come in different formats, and there are different ways to hold those keys. Some of them are based upon seed phrases. So if you memorize 12 words, or in some cases 24 words, that's enough entropy to generate a password, a secure password. And if you lose the exact password, but remember those 12 or 24 words in a certain sequence, you can basically walk across a border without having to sew diamonds or gold into your clothing and escape, or trust a Swiss bank, which we all know neither of those work all that well. And you can have that password, and if you lose your phone, which had your password, but you have those 12 words, you have your security back. So a wallet's is a fancy way for saying password manager, and get a good one. And again, keep things quite secure and safe investing to you. Eric?
Rick, thanks very much for demystifying some of those things. I'm still not sure I understand what an NFT is. It sounds like a numbered lithograph. But
SNL has a great skit.
Pete
Davidson, it's fantastic.
I'll look that one up. David, really interesting question from Andrew. I feel like we're on like a radio show, and Andrew just called in and he said, are those your real earlobes? Andrew's got a really good question about I won't read the whole question, but it's really about what unforeseen products do we think will come out of the digital asset environment? So you and I have collaborated on looking at a few fintech firms. Obviously, I wouldn't want to name any of them for obvious reasons.
Yep.
But when you think about cottage industries, is somebody going to sell, wallet software, or is somebody going to have a vending machine that takes digital assets payment? Like, what do you think is the some of the pathways of unforeseen products that will come out of this revolution?
Great question, and tons of answers. I in my head, I'm kind of logically segmenting them into like retail products and more enterprise products. I think that for most of the world, it's still a relatively high bar of entry to get into digital assets. And I'm not even going to touch on DeFi because that's even a higher bar. So it's probably even a subsection of the people that are in regular crypto getting into the DeFi world. I still think there's still a lot to happen in order to make it easy for people to really understand and get into it. There are definitely apps where you can go on and say I could buy and I can send, but as far as getting into things like NFTs and tokenization of assets, I still think that there's definitely a lot of room for companies to come in and try to make it like turnkey, point and click, and I can take an asset and I can tokenize it and I can now put it on the market, just for the regular Joe. Now, on the enterprise world, again, not to get into specifics, there is a ton of different types of technologies that traditional finance, is used to and uses. And there is definitely somewhat of a, I don't say immaturity, but there's definitely, a lack in the market for, again, surveillance and, tax software. There's definitely a delta right now where I feel that there's a huge opportunities for a lot of companies to come in and start offering enterprise level software in that space. I'm choosing my words carefully because I don't want to get into specifics. But on the other side of it, again, I mentioned earlier about Ethereum and the legal world. There's definitely companies that can come out and start create your own smart contract where you don't actually have to code and you can use plain language. So I think that there's, definitely a ton, as far as, I'm reading the question, as far as like how to evaluate it, I think it's really a matter of, is the market looking for it? When I evaluate companies that I'm investing in, who are the founders, what companies do they come from? Who are the other, co-investors? But I definitely think that the market right now, there's a ton of opportunities for a lot of fintech companies to come in and fill a lot of gaps today.
Great. Thank you. You mentioned smart contracts. Ian, I was speaking to somebody in the real estate world who was talking about digitizing real estate. So taking an office building, minting a custom coin, 1,000 coins to represent the building, and then selling those coins. Do you see, kind of in the future that people will tokenize hard assets? Instead of giving somebody shares in a corporation, they'll give you a unique token. Do you see that happening? And if you do, is that a 2022 thing or a 2030 thing?
Yeah, it's a really good question, Eric. And let's just try and talk about what the word smart contract means, right? First of all, two words, smart and contract. The word contract gives an illusion of a legal jurisdiction. The word smart implies that it's intelligent. And so when you try and combine those two words and create a smart contract, as they've used for both real estate, I mean, my example is in agriculture. So I understand, Eric, everyone's talking about it from a way of real estate, but in agriculture, it's starting to be used as well. But let me tell you why they're actually talking about it. They're talking about it because for the first time, if you go back to my very first comments, if frictions are reduced, that means a person from anywhere in the world who is not maybe a US citizen can buy a coin associated with US property or US agriculture or farmland. I own farmland. So, can buy farmland if they're not even a citizen of the country, and they get a small stake. So what is it really saying? It's trying to create liquidity where previously it was a captive market to a small audience. And the smart contract is designed to divvy it up. What was originally a very large asset pool that was only available to very rich people, suddenly if you cut it up into lots and lots of small squares, lots of people from multiple jurisdictions can buy it and say they have a small piece. A bit like the argument, can you afford a Picasso or a Rothko? Of course no. Can you afford a small piece of a digitized, authenticated NFT around a Rothko? Maybe, because it's going to cost you $100 instead of $40 million. So it's an interesting concept. The smart contract, you know, it's not a legal construct, but it's almost a liquidity type of mechanism if correctly done. But remember, smart contracts are not rules of law, they're rules of code. And so far, people think they understand it, but I will tell you, like most coins are shit coins, 99% of people that say they understand a smart contract are literally bullshitting, because they don't know how to read the contract. And more importantly, they don't know how to enforce the concepts of the language, which gets back to consensus mechanisms and lots of complexity. But smart contracts currently are being used to liquefy traditionally illiquid or large assets that were only available to small groups of people.
That's interesting. So it's kind of democratizing ownership of things.
Correct.
That's interesting. If you take that and I lost track. I think Rick or David, Rick, right? Who went before Ian? Okay, good. Just want to make sure. Sorry, losing my mind here. So if you take that democratization of ownership. So Rick, do you see, I mean, you work for one of the most topical trading companies around in digital assets. Do you think we're going to rock up to a, you know, kind of a Coke machine and pay in Bitcoin, whether it's on a credit card or anything else? And by the way, if I lose the key, it just disappears. My computer crashes. I didn't back it up or whatever, and I was going to buy a soda with it. Am I ever getting that digital asset back? Is there somebody like a bank that's kept a copy of it someplace? By the way, these were questions. I just paraphrased them. So
terrific. So soda machine pay with crypto exists. I think the entire country of El Salvador operates on that at the present moment. Other countries to follow suit. I walked into an ATM or to a business, and I was in Singapore, I think, and I was with a colleague in 2014, and he put a couple $100 US into an ATM and got back a little piece of paper with a cipher on it, you know, a password that showed his ownership of Bitcoin, and we videoed it because I thought that was the biggest waste of a couple $100 to go in. And like Ian, I was a skeptic or a cynic or both back then, and obviously, because a couple $100 is probably worth tens of thousands of dollars now, you know, so you know you can take fiat and buy digital. You can use digital and buy physical assets out of machines, and that's at this point is sort of kind of old tech. It's just right now you use a credit card anywhere or Apple Pay. It's a digitization of something that buys assets. So that's here to stay, and it's only going to accelerate. If you lose your wallet, or you know, you somehow your kid decides to use your bills as kindling, you're not getting that money back. If you lose your password, you are not getting your coin back. Now, that said, there are different ways to hold coin, and my comment earlier about moving to cold storage is exactly this. If you're holding on to your password, you're the only one that knows your password. It's called self-custody. That means you forget your password, you get amnesia, you lose your stuff. But you move something to cold storage, like at a firm like mine, and we have plenty of competitors, and they're all, you know, many of them are quite good at what they do. So we're not the only ones. But you move it to cold storage at a firm like Coinbase, we will then take custody of that key. We use lots of really cool math and physical security and cipher security and Faraday tents and all sorts of cool stuff to keep that really safe and super secure. And then you forget your password, that's fine. You know, we have it, we insure it, we have insurance policies and all the rest of that good stuff. And then it's on us. So we're then protecting it. So there are things you can do. So it's not just, that's not, self-custody isn't the only solution. And as we advocate for strong security, we also say, if you have a meaningful amount of assets, safe keep them, just like you buy insurance for your house or for a car. The equivalent of insurance for your digital assets is called cold storage.
Great, thank you. So if I own it myself, and I'm paraphrasing just to make sure I don't get it wrong, but if I took a $20 bill and set it on fire and it disappeared into ash, that would be losing my password. It's the same value destruction and you're never getting it back, as opposed to putting it in a bank where I can always show up with my driver's license and they may give me my money.
Pretty much.
So kind of taking this up, by the way, when you said Faraday tent, there's, 180 people, some of which are engineers, that get very excited that somebody used the word Faraday, myself included. So David, when you think about this from, and just kind of luck of the draw, not to give you the technology question again, but one of the folks that are on the webinar or the Zoom, whatever you call it, is asking about the obsoleteness, given that this is technology and we've got people that wrote a bunch of code and you've got Bitcoin and Ethereum and all these different distributed ledger technologies and crypto asset algorithms. Like, is there some obsoleteness that's going to happen at some point?
No. And the reason being is so Bitcoin, and again, I always just pick on Bitcoin and Ethereum because it's the most popular, but Bitcoin and Ethereum that exist today is not the same Bitcoin and Ethereum that existed when they were first founded. They're constantly evolving and they're changing and they're adding functionality. I forgot who mentioned it about Ethereum, burning gas. That's new. Bitcoin, there's something called SegWit, which is, a few years old. So there was, it was an attempt to, try to, again, not to get into specifics, but to try to, increase the efficiency of Bitcoin. So there was something called segregated witness, where they, changed the way in which the information is stored within the block. So no, it's not going, in my opinion, it's not going to become obsolete. Just in the mere sense that there's an active community that are always working on improving, the algorithm.
And just a follow-up question on that. So if somebody improves if I have a Bitcoin, if I have a coin of some kind, and somebody goes and updates the algorithm, like what is that? I don't understand, because I've got like the 1.0 coin. Does a new algorithm have a 1.1 coin? Like, is there a new version of the coin, or?
So there, it really depends on, what the change is, right? There's something called a hard fork and a soft fork. Some forks require an upgrade of software from a node, perspective. If you're running your own node, if you're, self-custodying and you have your own wallet, you may have to upgrade the software or the firmware. If you're custodying with somebody else, you rely on them, to upgrade their own infrastructure. So it really depends on what the upgrade is. But in some cases, yeah, you might have to upgrade your software in order to take part in the fork going forward.
Sounds very, I'm a technology guy. It sounds very technical, so there may be a follow-up conversation on that.
Sure.
Just looking at the time, we're about 5 minutes from the top of the hour, and we had scheduled this from 7 to 8 EST. There's a bunch more. There's quite a few more questions. If it's okay with everybody, I'd love to give the last question to Ian. We may run 1 or 2 minutes over. I'll give the last question to Ian, and then I think it'd be great for to the extent that the three of you are comfortable, to kind of give us your view of what the future looks like, right? Whether it's, the credit card, or whether it's, there's 12,000 coins and there's going to be 100,000 coins, or whether you have a prediction on the asset value of something. It'd be great for you guys to think about, you meet somebody on a bus and you have this conversation. Where do you think it's going? The last question, again, from the audience, from Ian, what role does crypto, somebody had mentioned Nicaragua, and there were stories of how Nicaragua rolled out Bitcoin as its national currency, I think. So the question from Daniel is, what role does crypto have in emerging markets and problems, and what problems can it solve that people in developed countries don't think about?
It's a great question. And I think it's one we always forget. Here in America, we talk about cryptocurrency as a cryptographic way to transfer value. But when you talk to anyone from the emerging world, it's a new version of trust. And for them, the trust is the metric that they're doing. So when you look at Nigeria, when you look at parts of Africa, parts of Latin America, right, Eastern Europe, these currencies represent a form of trust that the people have, which they do not have in the underlying government or bureaucracies that they're forced to live in based on their jurisdiction, their physical jurisdiction. So, you know, I've seen, for instance, the use of shopping cards, you know, the ones you get at Costco or Walmart, being utilized heavily for certain trade vehicles in Nigeria. And it was just really, really interesting how money is transferring in these countries. And when you ask anyone, why do you believe in Bitcoin or Ethereum? They look at you and go, well, why should I believe in my local currency? For them, it's an easy explanation. For us here, we're a first world country. We trust the banking system. There's no such concept as underbanked, you know, people who can't even get into the bank. But in the emerging market, it really is a very different psychology. And I think, you know, a lot of us, as I say, we view this whole discussion on Bitcoin and cryptocurrencies as technology. And I really think that's a gigantic mistake. We should view it instead as a new version of trust that is very well accepted by anyone under 35 in the developed world, but is also automatically accepted by anyone of most ages in the developed world. And so when you do that, basically the set diagrams or the way the ecosystem grows out means the community of trust shifts much greater in the emerging world than in the world of the developed world. So it's a great question. I could probably talk hours on it. I don't want to, but I think, you know, the receptivity of cryptocurrencies in the emerging world is far faster and less reported here in America, because what we like to talk about is, oh, I got rich because I bought some coin. But there's a trust mechanism that is intrinsic, that is occurring in pretty much every emerging world market that I've seen, including countries that have technically banned it, yet there are communities accepting and wanting it to grow within it. So I'll hand it back to you, Eric.
All right, that's great, and that's really helpful, because I think it is such a different perspective. You know, clearly a valid one, and you know, growth is regional in some ways, right? So let's reverse the order again. You know, we're at the top of the hour. If everybody's okay, we'll probably end in you know, something less than 10 minutes for those who can stay on. Let me reverse the order. You know, David, kind of wrapping up thoughts about the crypto world or the digital asset world. Where are we going in the world according to David?
You know, I'm really excited about tokenization, and not just say tokenization of you know, physical assets. You know, again, it creates liquidity in areas that were traditionally, you know, wasn't as easy to access the markets. You know, sure, you can have a REIT, you know, that holds real estate and you can own, you know, pieces of that, and you know, maybe at some point, you know, sell it. But you know, to physically tokenize, you know, a property, you own that property, and it creates liquidity in it. But what, you know, also you can even go one layer down. You can tokenize the revenue stream from the rent. You can tokenize revenue stream from a wind farm in New Zealand. I mean, there's so many different things that you can tokenize where, you know, to create a financial instrument or a product around these things, you know, was either difficult or just, you know, it wasn't worth it for large, you know, financial institutions to do it. But today, you know, that owner of that wind farm can just tokenize the revenue stream and just throw it out on the market. And I think it's exciting because it's going to ingest capital in parts of the world and in projects that may not have been have had access to that type of, you know, capital markets before. So I think we're going to see a shift in, different types of companies and different types of initiatives and things that really matter to certain people, because they're going to be able to access fundings for their projects. And I think that today's generation, that's really what's important to them. It's leaving the world in a better place. And I think this is a vehicle to give capital to those types of projects.
I love that vision. I'm gonna adopt it. Rick, same to you. From your vantage point, where do we end up in a year or two?
So a year or two is hard. I think just sort of pulling together themes from Ian and David, they both sort of spoke to something that's sort of core to what my firm drives for, which is sort of economic freedom. Ian talked about banking the unbanked or underbanked, which is sort of a hard concept for us to grok here in the West. And then David spoke about property rights, extending property rights, sort of democratizing access to capital markets. I think that those are sort of powerful forces that will have obvious impacts here in sort of the developed world and the developing world. I think it's going to be pretty transformative. So I think that's sort of short to medium term. I think the longer term, you sort of were itching for sort of a more provocative statement with your lead-in. I think bank will be a term that our grandkids sort of liken to VCRs. It's a concept that is sort of no longer makes sense. If we think about what banks do and what banks have done for the better part of a millennia, they do savings and deposits, borrowing and loans, they establish credit, they deploy capital. There's $100 billion locked up in DeFi, that's capital. They make money off intermediation. We have networks that do that better than any network that has ever existed with the internet. So I think that with this digitized trust, as Ian called it, and the reduction of frictions, I think that is a pretty potent sort of combination of factors. I think will make the next 10 years in the financial sector pretty interesting.
Very cool. I work for a bank, so I'm not really going to comment on that comment. And Ian, your view, where are we headed?
Yeah, well, first of all, if I knew, I'd be on my beach in Australia. But let me remind everyone, 1.5 years ago, the crypto market was $200 to $400 million. We've seen exponential growth in 1.5 years. It is now $3 trillion globally. The gold market is $10 trillion. The stock market of the globe is $100 trillion. The bond markets are $300 trillion. So if we tokenize, if we reduce frictions, if people can essentially create the Silicon Valley, but in a globalized, decentralized way, my answer would be bigger, but with extraordinary volatility to reach the end state. So crypto is notoriously volatile, extraordinarily dangerous if you don't know what you're doing. But if you study it, if you learn about it, there's a lot of free material, as David has said. There's something unique happening. We call it the paradigm shift, sure, fancy words, but the exponential rate of change from 3 trillion to 10 trillion to 100 trillion over 10 years is probably the most important way to think about step changes. And I can tell you, to remind everyone, the first 4 years I read the Bitcoin paper, I was not a believer, I was skeptical. But within 6 months of studying it, guess what? I realized I was the idiot because I used my historic knowledge to fail to understanding the relevance of code structure. And I think that's just important, to be open, to be adaptable, to understand exponential rate of change and volatility. It's not going to come for free. If you're scared of it, got it, then don't risk your money. But if you're willing to risk a portion of it, people always say 5% should go in gold, maybe 2.5% should go in crypto, 2.5% to gold. So that way you will have an exposure to it. And remember one statement that I think is very important. If you had $1 in 2010 and you invested 1 to 2 cents in crypto, you would have, in 2010, you would have outperformed every asset class in the last 11 years. That is an incredible thing with a 1 to 2% allocation Obviously, you're talking about the best time to enter, but the point is the rate of change was very important to think about emergence of an asset class. And I still think at 3 trillion, it's minute. It's really small still. So I'll leave that with you, Eric.
Well, thank you. Listen, hopefully you've heard from you can reach David, Rick, and Ian, from there. I believe all 3 of them are on LinkedIn if you want to, if you have reasons to connect. I want to thank you all for coming, and all the people who are on the Zoom for coming. It's a great conversation. I'm smarter. I think this is smarter for hearing it. I think the whole digital asset space is fascinating. I also appreciate the fact that you guys came to Cooper Union to have this conversation. Next time, hopefully we'll have the same conversation again, the next chapter of it in the Great Hall at Cooper. But it's it's a great cause to be a part of, and really glad that you all donated your time this evening. I want to recognize that our President Laura Sparks is on the Zoom, as is our board chair Malcolm King. So thank you guys for joining. I know we're a few minutes over. Thank you for all the people on the Zoom for tuning in to the conversation. Once again, I'd like to thank the panelists and Crystal and Mike for making sure that we were set up flawlessly. And if you want to continue the conversation, head over to LinkedIn and feel free to tap into us, and we'll be happy to come back to you. So thank you all, guys. Thank you very much. And I look forward to the next round.
Okay. Thank you.
Thank you.
Thank you,
Bye,
Eric.
everyone.
Good night, everybody.
Good night.